Hey everyone, welcome to this exclusive Trade with Zaman Intelligence Explainer. Today, we're diving deep into the seemingly contradictory state of Ethereum here in July 2026. If you've been watching the markets lately, you know exactly what I'm talking about. We are at a major, critical juncture. We're seeing this massive, frankly wild divergence between the structural growth of the Ethereum network and the intense price depreciation we're currently experiencing. So we're going to cut right through all the noise to bring you comprehensive, institutional-grade market intelligence. Let's get into it. Here is the roadmap for our briefing today. We're going to start off by unpacking the great Ethereum divergence. Then, we'll map out the key technical battlegrounds, contrast the ongoing retail panic against some serious corporate accumulation, break down the incoming Glamsterdam and Hegeta network upgrades, and finally, look at multi-horizon price forecasts heading toward 2030.
All right, Section 1, the Great Ethereum Divergence. This is literally the central mystery defining the crypto market right now.
We really have to ask ourselves, how on earth does an asset that just touched a 21-month low of $1,505 simultaneously break records for its ecosystem growth? It's like we're watching two entirely different realities playing out at the exact same time. On one hand, Ethereum just closed Q2 2026 down over 25%, which, by the way, marks its first three-quarter losing streak in history. Yet, completely behind the scenes, network adoption is compounding at a blistering rate.
Just think about the sheer contrast here. On the bearish side, we have the price action. ETH completely lost the crucial $2,000 level, plunging down to $1,505, mostly dragged down by heavy macroeconomic headwinds, a super hawkish Federal Reserve, and all those headline PCE inflation fears. But on the bullish side, the on-chain fundamentals are absolutely off the charts. Ecosystem liquidity exploded to $316.2 billion, up 22% in Q2 alone. Plus, a record-breaking 33% of the entire circulating supply is now locked up in staking. So, while the spot price bleeds, institutional total value locked is quietly cementing Ethereum as an absolute financial fortress.
Let's move into Section 2, key technical battlegrounds, because understanding this dynamic gives us a highly specific battlefield for advanced traders. $1,500. This is our red alert number. It's the critical psychological floor, and honestly, the line in the sand. Ethereum is hovering precariously close to this multi-touch support level. If we lose it, well, that risks triggering a massive cascade of leveraged long liquidations, sending the price tumbling down into much deeper macro support zones. On the flip side, we have our greenlit number, $1,810. This is the 50-day EMA resistance that bulls absolutely must break through. Right now, ETH is capped in a descending channel. To reverse the super rare weekly death cross we just witnessed, buyers have to summon enough volume to punch right through this major overhead supply block at 1,810. So, tying that all together for your TWZ strategy, these are the exact zones you need to watch to navigate this crazy short-term volatility. If that $1,500 floor gives way, we could be looking at a drop into the macro bottom range of $1,094 to $1,156, which, interestingly, Citigroup actually flags as the maximum value accumulation zone. On the upside, clearing 1810 is step one, but the real, definitive macro pivot sits at $2,135. A daily close above that level, that invalidates the bearish trend entirely. Moving to Section 3. Retail panic versus corporate accumulation. This is where things get really fascinating. The behavioral divide in the market right now is just staggering. Retail investors and ETF holders are running for the exits, de-risking amid macro fears. I mean, spot ETFs just suffered over $3 billion in outflows, and large whales dumped $880 million in a single week. But what's the smart money doing? Public corporations and treasuries are quietly treating this drawdown as a generational accumulation zone. Corporate treasuries now hold 1.3 million ETH. Bitmine Immersion alone holds an insane 5.6 million tokens globally. And we're seeing aggressive new buying from players like SharpLink. They are quite literally buying the dip. And it's not just about holding the asset on their balance sheets. Traditional finance giants are permanently anchoring to Ethereum to settle real-world assets, completely ignoring the short-term price noise. You've got BlackRock, JP Morgan, Apollo, and BNY Mellon all deploying massive multi-million-dollar tokenized funds directly onto Ethereum's base layer. This institutional tokenization moat proves that the big banks view Ethereum as critical, programmable financial infrastructure, no matter what the spot price is doing today. Nicole DeSico, the CEO of Crypto Consults, hit the nail on the head here. She noted,
The temporary pullback in ETH price is largely due to macroeconomic drag and liquidity rotation into Bitcoin, but the underlying fundamentals are strengthening. That perfectly sums up why institutional players are totally unfazed. They're looking at the actual roadmap, which brings us to the technological catalyst driving all this confidence. That brings us to Section 4, the Glamsterdam and Hegota upgrades. The smart money is positioning itself for the most ambitious throughput upgrades in Ethereum's entire history. We already saw the Pectra upgrade back in May 2025 expand blob capacity, but now all eyes are on Glamsterdam in the second half of this year, which is targeting a blistering 10,000 transactions per second. Right behind that is Hegota in late 2026, bringing advanced interoperability and zero-knowledge privacy. It's a relentless march, turning Ethereum into a high-speed global settlement layer. A huge part of Glamsterdam is a protocol upgrade called EPBS, or Enshrined Proposer Builder Separation. Look, the technical jargon sounds super complicated, but the concept is actually brilliant. It essentially separates the validator proposing a block from the entity actually building it. Why does that matter? Because it tackles the issue of maximum extractable value, or MEV, head-on. It cuts out centralized control and makes block production much cheaper and far more fair for everyday users. But, actually, we need to be totally objective here, because there is a catch. The incredible success of all these scaling upgrades has created a very unique problem. Layer 2 networks are working so well that they are literally cannibalizing mainnet fees. Layer 1 revenues plummeted down to just $10.7 million in June 2026. This massive drop in transaction volume has severely curtailed the ETH burn rate, meaning Ethereum is slightly inflationary again right now. It definitely weakens that ultrasound money narrative for the moment, and this structural shift is a massive factor suppressing the price. All right, Section 5, multi-horizon price forecasts. Let's look at how all this resolves over the next few years. So how do these conflicting forces, weak technicals versus booming institutional adoption, play out by the end of the decade? Institutional analysts are projecting a massive long-term convergence of price and utility. The Motley Fool takes a pretty conservative approach, valuing ETH like a software stock with a $5,000 target by 2030. But as you move up the curve, it gets wild. Standard Chartered projects $40,000 as ETH becomes the dominant global settlement layer. And Van Eck, their cash flow models project a staggering $55,000 terminal valuation. They are heavily betting that today's growing pains are going to yield massive dividends down the road. So I'll leave you with this final, provocative thought to factor into your TWZ strategy. As we watch retail investors panic and ETFs bleed, we simultaneously see the world's biggest financial institutions and corporations quietly scooping up millions of tokens. If the long-term thesis of Ethereum acting as the backbone of global finance is actually intact, is the current pain around this $1,500 floor actually your greatest opportunity? Keep a close eye on those key technical levels, watch institutional flows, and stay focused out there. Thanks for joining this explainer, and we'll see you next time.